In this video, we will analyze yield basis. We will cover how yield basis enables one of the highest Bitcoin and Ethereum yield opportunities in DeFi without having to deal with impermanent loss. As always, we will also talk about the market opportunity, the valuation of yield basis native token YB, and potential protocol risks. At the end of the video, I'll give you my personal opinion in what case I would consider YB an interesting investment. Not financial advice, of course. Let's get right to it. So first of all, let's go over our options of on-chain Bitcoin yield. We have really limited options here, and the risk-adjusted returns are really not that great. The most used option here by TVL is Aave and Babylon, and both of these options barely give any yield. And then we have some other options where you have to lock your Bitcoin in an obscure layer 2, or you have to buy some other token to boost your reward. So all of these are really high risk and don't really justify the returns. What we are going to focus on today is providing liquidity on a traditional automated market maker or decentralized exchange, which yields traditionally between 5 to 15%, but bears impermanent loss, and you have to convert half of your position into another token. We'll cover more on that in the next slide. And yield basis, we are going to look closer into yield basis, how it solves the impermanent loss problem, and talk about chances and risks. Okay, how does one provide liquidity on a traditional automated market maker or decentralized exchange? We have our anonymous user here, and he wants to earn yield on his Bitcoin. Bitcoin is at $100,000. On Uniswap, I have two pools which pair tokens. For example, wrapped Bitcoin and USDC. And traders can now come and swap their Bitcoin and put it into the Bitcoin bucket and convert it into USDC by taking USDC out of the USDC bucket. And of course, this also works vice versa. And for the conversion, every time they convert their Bitcoin into USDC and vice versa, they have to pay a fee. Now, our anonymous user could provide liquidity on Uniswap by converting half of his Bitcoin into USDC and providing half a Bitcoin into the Bitcoin bucket and 50,000 worth of USDC into the USDC bucket. And in return, he will get back an LP token, which represents the percentage of his pool share. In this case, we'll have 5 Bitcoins in the Bitcoin bucket and 500,000 USDC in the USDC bucket. So our user here has 10% of the pool share. And so when traders swap, 10% of all fees paid is going back to our anonymous user here because he owns 10% of the assets in the Bitcoin and USDC pool. At some point, he will want to withdraw his assets again and realize the yield. So he will get back half a Bitcoin plus the 50,000 USDC and the accumulated fees. But it's not that easy because the ratio between the Bitcoin and USDC could also change based on the price on Bitcoin. And this ratio, pool ratio, is determined by a set formula. And I used the most simple formula just to make an illustrative example here of how the rebalancing in these liquidity pools work. But for now, just keep in mind, he might get back more or less Bitcoin and more or less USDC plus his accumulated fees. So what does that exactly mean now? Let's keep in mind our last slide here and talk about impermanent loss. We assumed that Bitcoin has a price of $100,000 and the pool formula was X times Y equals K. 5 BTC times 500,000 USDC is 2.5 million. Now, let's assume a situation where the Bitcoin price increases by 400%. So Bitcoin now stands at 400,000. Now, how does the pool ratio change right now? Well, there's a mathematical formula for that, which you can see here. I won't get into details about the mathematical formula. There are other videos for that. But the bottom line here is that the Bitcoin share decreases by 50%. So there are only 2.5 Bitcoin now in the in the Bitcoin side of the pool, and 1 million USDC. So the USDC part doubled in value on the USDC side in the pool. The ratio changes into the exact opposite if Bitcoin loses 75% of its value. Now Bitcoin is worth $25,000. We apply this formula, and on the Bitcoin side, we have now 10 Bitcoin, and on the USDC side, we have 250,000 USDC now. What does that mean for our liquidity provider? Let's remember he owns 10% of the pool. So he provided at 100,000 Bitcoin, half a Bitcoin and 50,000 USDC. Now Bitcoin quadrupled. He gets only back 1/4 of a Bitcoin and 100,000 USDC. In the case of Bitcoin going to $25,000, he gets back a whole Bitcoin. So he doubled his Bitcoin position, but he halved his USDC position. So why is this even important? Well, let's look at the profit and loss statement after a 1-year holding period. So we have 3 anonymous users here. The first one just holds 1 Bitcoin. The second one holds half a Bitcoin and 50,000 USDC. And the third one provides half a Bitcoin and 50,000 USDC into a Uniswap pool that earns him 20% a year. And 20%, by the way, is really high. So if Bitcoin does nothing after 1 year and still stands at $100,000, well, then the liquidity position is obviously the best choice because the liquidity provider earned 20% on his position. He now has $120,000. The value of half a Bitcoin and USDC didn't change, and the value of the Bitcoin didn't change also. And you can see this here in this calculation as well. Now, the second case gets more interesting. Let's assume that after 1 year, Bitcoin went from 100K to $400,000. Now our Bitcoin holder has $400,000 with 1 Bitcoin. The second anonymous user has half a Bitcoin. His half a Bitcoin position doubled in value, and he still has his 50K USDC. So now he has 250,000 US dollars. Our liquidity provider actually has less than the guy who just held Bitcoin and USDC. Why? Because his Bitcoin position halved. He provided initially half a Bitcoin, but he only gets back 1/4 of a Bitcoin, which is worth $100,000. He'll get also in addition 100,000 USDC, which is $200,000, and would have earned 20%, which is $40,000 on top of that. But it's still less than the user who just held half a Bitcoin and a $50,000 USDC position. What happens in the third case? If Bitcoin loses 75% in value, well, then our Bitcoin holder is obviously the worst off with his Bitcoin being worth only $25,000. The anonymous user just held Bitcoin USDC without doing anything, has now a position worth of $75,000. And the liquidity provider is still worse off than the guy who just held a 50-50 Bitcoin USDC ratio. Why? Because he will get back 1 Bitcoin. Now his Bitcoin position doubled, and he will get back $25,000 worth of USDC, which is $50,000, and he would have made 20% in profit, which is $10,000. So in total, a liquidity position that is worth $60,000, which again is less worth than the guy who just held Bitcoin and USDC in a 50-50 ratio. This concept that the liquidity position is worse off than someone who just held Bitcoin and USDC in a 50-50 ratio is called loss versus rebalancing. And the problem here is really that by providing liquidity, users sell low and buy high. So they're choosing basically the worst trading strategy possible. When Bitcoin increases in value, they're selling their Bitcoin position off. And when Bitcoin decreases in value, they will increase their Bitcoin position. So how is yield basis solving this problem? Well, let's assume we have our user again with his one Bitcoin worth $100,000. And now we are talking about Curve and not Uniswap, but the mechanism is basically the same. Uniswap is an AMM and Curve is an automated market maker as well. The liquidity provider gives his Bitcoin into yield bases. Now, yield bases will be pairing Bitcoin of the user with CRV USD from Llama Land. What is Llama Land? Llama Land is basically a lending protocol that is built on top of Curve, and users can lock their collateral, for example, Ethereum or Wrapped Bitcoin, into Llama Land and receive back this stablecoin CRV USD. But Llama Land can not only be a lender for individual users, but also for the protocol yield bases. So it will provide the other side of the liquidity pool in CRV USD. So that means that the user with his one Bitcoin now keeps his one Bitcoin in the liquidity position and gets a loan of $100,000 to match the other half and provide that into the liquidity bucket on Curve. Now, how is this loan collateralized? Because in order to get a loan, you always need over collateralization in crypto. Well, if the user provides Bitcoin and CRV USD into the pool, there will be an LP token which is worth $200,000. So the LP token will be used as collateral on Llama Land to back the CRV USD loan. Now the user earns yield on his one Bitcoin and the $100,000 CRV USD position. So he earns swap fees on in total $200,000 and not $100,000 because he didn't have to convert half of his Bitcoin. If the user wants to withdraw his Bitcoin, how can protocols unwind this process? Well, the liquidity is withdrawn from the pool. The 100,000 CRV USD plus interest rates are paid back to Llama Land. When the loan is paid back, the liquidity token that represents the user's pool share is burned, and the Bitcoin are paid back to yield bases and then in turn to the user. And the user gets back his one Bitcoin plus double the yield because he earned money on a $200,000 position rather than a $100,000 position he would have had if he had to convert half of his Bitcoin into a stablecoin and provide it into the liquidity bucket here. Now that we talked about how the product yield basis works, let's talk about the market opportunity here. So the total addressable market right now for yield basis is 50 billion TVL of Bitcoin liquidity and 15 plus billion of ETH liquidity. How do I come to that total addressable market? Well, the founder of Yield Basis calculated the potential returns on providing Bitcoin liquidity and came to the conclusion that the yield basis liquidity only saturates when it begins suppressing Bitcoin's global volatility. And that would happen at 50 billion TVL in the Curve pools. I'm not aware of similar calculations for Ethereum, but let's just be conservative here and say this saturation for Ethereum will take place at 15 plus billion TVL in the Curve pool. That would be a potential TVL for yield basis of $65 billion. What's the serviceable addressable market? Well, I assumed here that if yields stay relatively high between 10 and 20%, then 20% of the total wrapped Bitcoin in DeFi and 5% of yield-seeking Ethereum could end up in the protocol yield basis as TVL. The current TVL of yield basis is right around $250 million and is capped at the moment, and we will talk about later why this is. Let's first talk about tokenomics real quick. Yield basis has its own native token YB, and the total supply is 1 billion YB. And this looks really confusing, but we can break it down really simple here. The biggest position is liquidity incentive. So for people that are willing to provide their Bitcoin or Ethereum in order to get this new protocol going. The next biggest allocation is the team allocation with 25%. And really, when we talk about the team allocation, I also count into that the protocol development reserve, the ecosystem reserve, and the curve licensing, since all of these tokens will give an incentive to the core team to develop the protocol. And all of these positions together would get us to slightly over 50%, 52.5% to be exact. And the last bucket I will mention here is the investors allocation with 12.1%. These investors invested at a seed round at 50 million fully diluted valuation. Keep this number in mind. We'll come back to that later. Now let's talk about token unlocks here. The most critical date here will be March 15th in Q1 still, because the linear vesting of team and investors will start at this date. And in Q2 alone, roughly 60 million YB will enter the market. At the current market price of 25 cents, that's roughly $14.7 million worth of sell pressure. Then over the full year of 2026, 210 million YB will enter the system, which is $52.5 million and roughly 20% of the total token supply. Keep in mind the current circulating supply is roughly between 8 and 10%, so that's a huge increase over this year. And then by the end of 2027, 520 million YB will be unlocked, which is a potential sell pressure of 130 million US dollars at the current price of 25 cents. And considering that the team really has a cost basis of 0 because they allocated the tokens to themselves, and investors had an entry at 50 million fully diluted valuation, there's still a lot of potential sell pressure here because we're at a market capitalization of $180 million here, which is a 3.5x for everyone who bought the token at the seed round. Now, before we talk about the token utility, we have to talk about the value flow. Where is the money coming from? And for that, we have to keep in mind the liquidity provisioning here, because the money is essentially coming from the traders that are trading wrapped Bitcoin into CRV USD or vice versa. And this will define the revenue of yield basis. Now we have to deduct the costs of the revenue, and this will equal the profit. 50% of all the revenue will be used to rebalance the pool so that Bitcoin has always the right dollar price. Curve has built in a special formula according to which the liquidity is allocated around the current market price, and the protocol constantly rebalances these pool positions, which bears a lot of costs. Then from the other 50%, we have to deduct the volatility decay, which is essentially the cost to maintain a 2x leverage position. As we can remember, our user borrowed CRV USD and provided it into the liquidity pool, which is a 2x leverage he earns trading fees on. And in order to maintain that balance, especially the liquidity provider token, which has to collateralize the loan, we have to pay some costs. First of all, we borrowed the CRV USD rate, which has a borrow rate we have to pay. Then there are AMM spreads, there are gas fees to cover, and arbitrageurs. So all of this have to be deducted. The rest will be the yield basis profit, and the profit will flow according to a mathematical formula to YB lockers of the native token of the protocol, and liquidity providers, of course, the people that provide liquidity into the curve pools. The good thing about this is you don't necessarily have to understand anything of that, because if you go to the yield basis website, the reward APYs that are shown on the website already include all of these costs and are pure profit. Now that we roughly know how the value flow of yield basis works, now we can talk about the token utility. So as always, we have our anonymous user who's looking for Bitcoin yield, and now he provides his wrapped Bitcoin into yield basis the protocol. Now he can choose between two reward mechanisms. First, he can choose to auto compound his Bitcoin yield. If he chooses that option, then the path really ends there. He will just provide his liquidity, earn yield on his Bitcoin, and that's about it. He could potentially also forego his Bitcoin yield and earn the protocol native token YB. Where's this YB coming from? Well, we talked about the 30% allocation of liquidity incentives in the token distribution section. These 30% are allocated to incentivize liquidity providers and to get the whole mechanism going. If he chooses the YB token, what will he be able to do with this token? Well, he can lock the token into the yield basis protocol. The longer he locks his token, the higher weight his token will have. He can decide over protocol governance decisions and earn part of the Bitcoin and Ethereum yield that the protocol is generating, because the protocol takes a minimum 10% administration fee and also collects all the foregone liquidity provider rewards, where people choose the yield basis token instead of the Bitcoin token, and redistributes these rewards to VEYB lockers according to their token weight. Now, if the majority of the liquidity providers choose the Bitcoin and Ethereum native yield, so going this route, the admin fees will stay at a minimum around 10%, and the liquidity fees here will be really, really low, because barely anyone wants the yield basis token as an incentivation. On the contrast, if more liquidity providers choose the YB token as a reward mechanism, the administration fees will go up. More people are foregoing their Bitcoin and Ethereum yield, so the protocol can take a higher share and redistribute that higher share to YB lockers. And the liquidity incentives, because more people are choosing the YB token as incentive mechanism, will be emitted at a higher rate. Now, when it comes to the valuation, the YB token right now stands at roughly 25 cents. This gives it a fully diluted valuation of $178 million. And based on the past earnings, the protocol roughly launched at the 15th of October. So it's live now 3.5 months. Protocol fees collected so far are $1.92 million. Those are the admin fees we talked about earlier. When we annualize this number, we'll get $6.6 million of annualized protocol profits. And if we divide that by the current market fully diluted valuation, we'll get a multiple of roughly 27x. A bit later, I'll talk about why the valuation doesn't give a good buy or sell signal of the protocol, because the protocol is super cyclical, meaning when the overall market volatility increases and the protocol becomes more profitable, then the earnings number will shoot through the roof, obviously, and the valuation multiple will of course adjust accordingly. Now, what are the mechanism risks here? First of all, if rapid price movements occur, the protocol will have a hard time to rebalance and will pay a lot of gas fees to cover these costs. In some situations, there could be a temporary loss on the liquidity provider position, but this will be compensated over the long term if the liquidity provider stays long enough in the protocol. Of course, there are also smart contract risks. Then if there's high transaction demand on Ethereum, the gas cost will increase a lot, and this will increase the cost of the overall protocol, which will diminish the profitability of the protocol and its liquidity providers. And there is also a competition risk. If some protocol might find a similar mechanism to mitigate impermanent loss, then yield basis might become irrelevant. We have still more risks. Let's mention a few dependency and economic risks. So we have the wrapped Bitcoin risk, of course. I mean, any of these wrapped Bitcoin solutions are essentially custodial risks, then yield basis is very dependent on the Curve ecosystem. This is not necessarily super dangerous since they have the same founder, Egorov, so that probably won't be a problem since Egorov will be always acting in the best interest of yield basis and Curve. But we have also a question of yield sustainability because historically Bitcoin and Ethereum have declining volatility, meaning they get less and less volatile every year. And less volatility means less trading volume. So the 10 to 20% historical APR that Egorov calculated, a liquidity provider would get on his Bitcoin and Ethereum yield might not apply for the future. And then really the most noteworthy risk right now. Why? Because it also right now presents a scaling bottleneck for yield basis as a protocol, the CRV USD stability risk, because yield basis is dependent on that CRV USD always holds his peg to $1. And if yield basis were to become too big in TVL, it could endanger the peg stability of CRV USD because it's the biggest lender of CRV USD, and therefore there are TVL caps set in place at the moment on yield basis. A potential solution for the CRV USD stability risk are hybrid vaults. When a user wants to provide his Bitcoin or Ethereum into yield basis, he has to provide a certain amount of CRV USD into the hybrid vault in order to be able to enter the yield basis earnings protocol. How does that work exactly? Well, he could acquire CRV USD on the open market by swapping his assets into CRV USD, or he could collateralize his assets on Llama Land and borrow CRV USD against them. Then in turn, he would provide these CRV USD into the hybrid vault and earn 2.5% on this hybrid vault, and therefore unlock a position in the Bitcoin or Ethereum yield protocol. If the user were to provide $100 worth of CRV USD, then he could provide $250 worth of Bitcoin into the protocol. Essentially, the user is always able to provide 2.5x the value of his CRV USD position in the hybrid vault as a Bitcoin or wrapped Ethereum yield position. Or you can also express it in 40% has to be in CRV USD, 60% will be in wrapped Bitcoin or Ethereum. And this position will be earning most likely between 10 and 20%. Now, what's the conclusion here and what are factors to watch? Well, let's talk about the opportunities, challenges, and a potential investment case. There's obviously a super big market for Bitcoin and ETH yielding products. I think over the next years, this will grow into a multi-trillion-dollar market. So if yield basis could capture a part of this market, it will grow its TVL and therefore its revenue and protocol fees at least 10x. The challenges are the scalability and the dependency on the CRV USD stablecoin. The whole mechanism is basically right now dependent on this, and we'll see if yield basis will be able to come up with a good solution for that. In the short term, also market conditions might not favor yield basis because right now the volatility is really low, and I think over 2026 the generally liquidity providers APRs might not be that high because there's not that high of an interest in on-chain trading overall. But like I mentioned, this is only more of a short-term risk. And of course, from March on, 52% of all tokens will unlock until the end of 2027, which at this current valuation could still be a good opportunity for early investors and team members to cash out some profits, and therefore the price might still fall. So now is the question, when would I be interested to buy? Well, if an interesting level would be a valuation of yield basis between 50 to 100 million in a fully diluted valuation, but only if they will be able to solve the scalability problem with CRV USD. I think the hybrid vaults are a good start, but they still also present some challenges. They prevent the impermanent loss to happen, but users will have an opportunity cost because 2.5% on CRV-USD is not really a high yield. There are protocols that offer way higher yields on stablecoins right now. And also some users might not be willing to hold stablecoins at all, since they want to have 100% market exposure, which was offered by yield basis before, earn yields on 100% market exposure, but now the users always have to have a 40% stablecoin position. That's not really an optimal solution. I don't really know what the answer here is. If they could do a collaboration with SUSDS, which is the stablecoin of the Sky ecosystem, or potentially USDE, the stablecoin of Ethena protocol. But the bottom line is they have to come up with a solution. Otherwise, the protocol will not be able to scale, and therefore never will be able to capture a bigger size of the Bitcoin and ETH yield market share. And that's it with the video, guys. If you like this video, please like and subscribe, and let me know what you think about yield basis protocol. See you in the next video. Bye bye.